This week we're reviewing the Investec Active Quants Fund, and Cobie is going to set the scene for us.
Thanks, Selene. I mean, we've gone through, we haven't done a fund focus for a while now. I mean, we did a whole section around alternative asset classes and Regulation 28, which is the Pension Funds Act. So this is the first time around we're doing a fund focus again. Investec Active Quants Fund manager there is Grandover and Smith. I mean, he's been with Investec for many years. Formation date April 2005. You see the fund size there at 347 million. Not a very large fund. Benchmark there, shareholder weighted index, which is the derivative of the all share index. Down weighted some of the very large cappers, and you can see the total expense ratio there up to the end of March 2010. There is a performance sharing ratio here that applies about 20% above a hurdle rate that they charge as portion of the total expense ratios. Just looking at returns, there you can see them. 12 months, 9.8 versus the shareholder weighted index of 9.5, 14.7 versus 14.3 over 2 years. And it's just jumped down to the 5-year number there, 10.7% versus a shareholder weighted index of 10.5. Anything above 12 months is all per annum. So those are all annualized
so slightly
returns.
Outperforming
Absolutely,
the benchmark.
yes.
And this is included with, I mean, when you extrapolate the fee that you pay as well.
Yeah, so these are all net fees. So the fee really wouldn't be subtracted out of it. That's industry standard, and most funds would show you returns as far as that's concerned. Just to refresh your memory here again, the blue bars or the blue shaded areas indicate the fund's relative return to the benchmark, and there you can see the profile of the fund. So when you're on the rolling 12-month basis, take the fund's return and you minus the benchmark, you get that kind of profile that you're seeing over there. What did the benchmark actually do? The shareholder weighted index, you can see that in the red line that you're seeing over there, and you can see how the performance kind of looks. So let's just look at the outperformance and the underperformances for this fund. During 2008, and that's obviously, that's portion of the returns are obviously whilst the markets were doing very well, and then as the markets kind of crashed, you see some outperformance that kind of then turns into negative returns over here. As the market kind of recovers, on the other end of over here, you see pretty decent outperformance. And I'm going to substantiate what Roland said just now. Look at 2011. Most of the returns over there, 2011, has been actually quite tough to beat the benchmarks. Just from a process and a philosophy perspective, it's an equity active fund over here with a quantitative overlay. And what they're trying to do is they're trying to use a quantitative screen in order to show specifically value-based opportunities here.
Do you like this fund, and do you agree with the benchmark?
I'm biased because this is a quants fund, and I like quants funds because they are systematic. There is a sort of rules-based approach that they apply, so one can actually test rather than if it's just a subjective call of the fund manager whether a stock is, you know, good or bad, or whether they like it or not. The interesting thing about this fund, which is slightly different to most other funds, is that it actually has one of the highest, what we call gearings to the market. There's a technical term called beta, and on average it's about 1. So it's actually, when the market goes up 10%, this fund tends to go up the same amount, 10%. Yeah. Most funds are defensive, so when the market goes up 10%, they don't go up as much. And in the long run, if you are a fund manager, you know, I don't understand why fund managers are always defensive, because in the long run you are going to underperform the market by being constantly under geared to the market. So this fund maintains a gearing quite close to the market's returns, but it can go up to 1.2 or 0.8 times what the market returns.
But it's not fantastic return that we've actually seen over the past while. I mean, relative to the numbers that Cobie showed.
That's true, but 80 to 85%. I just did the study 2 weeks ago using Morningstar data. 85% of the funds in South Africa underperform the all share index or the SWIX kind of benchmark. So this fund hasn't underperformed. So it's actually one of the better funds.
You see, if you're trying to achieve, let's assume you want to be active, but you want to make sure that there's a quantitative overlay to what you're doing. So you know that you're using your SWIX as far as asset liability modeling is concerned. So the SWIX is the input parameter over here. And you're utilizing this fund, and you want to know that at least there's a chance for outperformance, but if there's going to be an underperformance, there's not going to be massive deviation. This is a fairly decent fund to use. You're not seeing those deep value type funds where you have a market that crashes and then the deviance away from the benchmark is massive. You're not seeing that in this situation. Returns look quite similar to benchmarks, but there is outperformance for the risk that you're assuming.
The one thing about this fund at the moment, in the last few weeks or months, I've looked at the gearings to the industrial resources and financial index, and the fund managers closed down all the bets. So it's pretty much one-for-one to all the sector kind of exposures as well as to the market. So it's literally now like the market, whereas before it took bets either way. And I guess in this kind of market, when there's so much uncertainty, what do you do as a fund manager? You probably go back to the basics, which is trying to stick to what the market
is doing. I mean, industry sector allocation with regards to the fund, financials make up around 25%, basic materials 23%, telecoms 10%. We've got oil and gas sitting at 8.8%, and top 10 holdings, Sasol at the top, Vodacom, Anglo-American, Kumbai and all. These are the kind of companies and, of course, sectors that are doing quite well. It's interesting, the financial side, though, that it's got such a big
Those holdings
weighting.
are probably a few months out of date compared to what's happening now, whereas what I've been looking at is literally in the last weeks, what is driving the fund in terms of the exposure.
So it's shifted away from financials.
It's pretty much neutral to financials, what the benchmark is. So it's closed down most of the bets. Most fund managers will have a value bias, you know, whereas this fund is not that defensive at the moment. It's just the market.
So is it right to say then we need to actually, as any investor out there, have a passive way of investing coupled with active fund management as well?
Again, it depends what your
best.
It depends what your objective is, Eleni. I say to people, if you are going to be desperately unhappy if you're away from the benchmark, hence it's going to be the end of your world, then maybe what you should consider is something passive. And if you then want to combine something active with that, the question is how do you combine that and what suits your kind of risk profiling at the end of the day. From a risk-adjusted perspective, what kind of returns do you want to achieve? If you say to me today that the benchmark means nothing to you and the deviance away from it, you know, I want to buy cheap companies, that's all I want to do, then there's a specific place for those kind of people as well. Being passive is not going to necessarily help you. And that's why, and this is why the fight in the industry around passive versus active is such a silly fight at the end of the day, because there's different alternatives for different investors, and different investors kind of set the pace as far as those alternatives.
And that's not to say that you have to stick to one specific method, though.
Absolutely.
I firmly believe you should do both. I mean, if in the long run, over 3 to 5 years, 80% of funds underperform the market, you've got to have some passive in your portfolio. Sure, you should have active as well, but not to have any passive wouldn't be the ideal benefit-cost ratio.
Okay, let's wrap things up. Cobie.
Luck versus skill. Luck versus skill. I think this fund has both.
Are you a lucky man, Cobie?
Am I a lucky man? You know what? In asset management, you need some luck. You do. You know, you want to create those kind of double-digit type returns. You know, if you've got cash in the market and it's the bottom end of the cycle, you're going to do very well.
And are you allocating money now to the markets?
Well, I mean, I think that global equities relative to South African equities are cheap. And one should certainly be looking at, you know, some alternatives in that space, you know, and then you should be investing again, not for the next 12 months. You should be investing for the next 5 to 10 years.
Roland.
It's not about luck versus skill. It's about what's driving the portfolios, and that tends to be the risks which are out of our control.
So we need to focus on risk according to...
Spoken like a true quant, eh?